Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about inventory and inflation and what's going on with the Fed. First, here's a word from our sponsor. This is Sarah Wheeler, Editor-in-Chief at HousingWire, with Melinda Wilner, Chief Operating Officer at UWM. Melinda, what types of products and enhancements has UWM rolled out this year to help set brokers up for success?
It's been a big year for us of rolling out product updates and some enhancements to our tools. Our whole goal always is to make the broker succeed in whatever cycle is around. So we do everything we can to focus on the broker experience and, really importantly, focus on the borrower experience. So a few of the things we've done this year, Safe Check Complete has been a recent rollout for us. Our 1% down program has been an absolute hit to really help in that affordable space and to help people get into homes who couldn't otherwise do so. We've had some great product expansions with our bank statement program, as well as our jumbo program, to allow more flexibility and to fit more borrowers into there. So it's really been a great year. We've done a lot of great things that we're really happy about, really proud of.
A lot of robust products, and listeners, you can find out more at uwm.com. Logan, welcome back to the podcast.
Sarah, how are you doing today?
You know, I knew you were going to bring this up first thing.
I just want to make sure, there's no hard feelings since we work together, and a lot of people enjoy our banter, but after a defeat like that, and I just felt bad when you asked the attendance, the people attending the conference, said how many hands would raise for the mortgage rate lockdown, and it just wasn't a lot. So
it was not a lot.
Want to make sure everything's okay.
Everything is good. I am a good loser. I also know that there are many people who were not in that room who support me on the mortgage rate lockdown, but I actually think it was a great discussion because you went through all your points. I brought up, counterpoints. It did not win over the audience, but we did have a good discussion. And afterwards, we talked to a lot of people who liked the dichotomy of what I was really talking about was transactions, what you were really talking about was inventory. So,
Sarah, when it comes down to it, winning is everything.
Yes, I know. As you made clear. So just so our audience understands, we did that at HousingWire Annual yesterday. We closed out the conference with it. It was actually really fun. Tons of people stayed in the room. And then at the end, we invited their questions. It was a really interactive thing. So very fun. Glad we did it, even though I lost.
It's okay. It's, fighting, most people don't even dare to even challenge me. So it's a good thing that you're willing to go out there.
I am willing, and I actually still think I'm right. So
I know you still think you won.
I do.
There's a lot of housing bubble boys who think they have won for the last 12 years too. So now you know how they feel.
I'm not one of those. Okay, I do want to talk about inventory, right? So this is really the time of the year where we typically see a seasonal decline, but this has been such a crazy year for everything. So let's talk about inventory and how we might see some more inventory.
So part of the mortgage rate lockdown discussion, for me at least, has always been in the case that the way that we've seen inventory grow post 2010 has been higher rates, days on markets grow, and inventory accumulates higher. And I think right now, with what we have dealt with in 2020, 2021, 2022, and in 2023, we have these huge housing events with COVID, forbearance, 7% mortgage rates in 2022. But also here, you have near 21st century lows in demand. And the growth rate of inventory, at least even to this week, is negative year over year. You working from a very low bar too. It's not like we're anywhere near the 50-year average of active listings. But I think trying to convey this story that credit channels run inventory channels, higher mortgage rates, days on market grow. So why has inventory been negative year over year this year? Well, a few things is, number one, demand has stabilized. Right, we had home sales went from 6.5 million to 4 million. And then we had that bounce from 4 million to 4.55 million. And then we've been slowly moving lower. So, it's going to take, higher rates and more weakness in demand to get inventory growth. But also new listings data took another leg lower, as some people just affordability issues. You can't literally list your house. Your mortgage person's going to tell you, hey, you don't qualify for your next home. So when you sell, you're renting. And, higher rates for longer can create more active listings, but the issue that's happened in the housing market is, and this is why I've always stressed, we literally had the biggest one-year sale crash ever in history. From 2005, it took years to get to the 2008 levels. Here we did it in 12 months. So the withdrawal of activity, this is why I don't understand some of the Fed's talks about housing. They go, housing's recovering. The absolute income and jobs and transaction volume collapsed in the biggest fashion in history, and they're talking about a recovery, and it's not happening in the data lines. So that's the existing home sales market. Of course, the new home sales market is different. They can pay down rates, and new home sales are growing year over year. But in this environment, it's such a slugfest to grow active listings. And what we saw is when mortgage rates do get above 7%, while we haven't hit our targets, the growth rate of inventory has picked up a little bit more than what we are in a trend. And maybe it's just going to take higher rates for longer in that context, which is a total divergence from what people have talked about. We're always on the verge of a big supply spike because Americans are poor, they're not very educated, they don't read, which is not the case. Most people read. Literacy rates are high. And they assume that these people will sell to be homeless. So that's not the case. But over time, in a major slugfest, you can have inventory growth. And this is why I think 2024, this 5-year period of mine, I've been waiting for 10 years. 2024 spring inventory is going to be like really interesting, because as of now, mortgage rates have not taken that leg lower like it did last year, where we went from 7.375% down to 6%. Rates are crazy, of course, that we've all seen recently, but it'll be interesting to see if we don't have a kind of an abnormal event toward the end of the year. Can inventory just naturally grow like it has in the past, where we see active listings grow? And it's confusing again, because when people think home sales are crashing, inventory should skyrocket, home prices should collapse. Everyone says this on many social media fronts. Prices follow volume. Well, we had the biggest home sale crash ever, and existing home prices went up. So the model broke on them. So for 14 years, I've heard this, and here's the best example in ever history. It reversed. And again, that's credit channels, inventory channels, buyers and sellers. Sellers are not stressed. They don't have to do anything you want them to do. There are some that actually will cut prices and do what they need to do to get the products, but we're just still at a very stable environment in terms of sales, only because existing home sales fell so much last year.
So last year we had that spike in purchase applications because we saw, interest rates go down just a little bit, right? I mean, it just got into a range that people were like, okay, I'm going to go ahead and make the plunge. And so we got, I think, 3 months, right, of purchase applications that ended up,
Yeah, we got it. See, yeah, lower rates with duration works in the sense that the purchase application data flowing, and this is why I've always said, I always repeat this. What I see out there is people don't know how to track the MBA purchase application data correctly. And that's just experience. Like if you are not religiously following housing data day to day for over 10 years, you wouldn't know. You're just making stuff up. A lot of people just make stuff up. So the forward-looking data, we did this in June. The forward-looking data got better in front of everyone, and the national media and stock traders and YouTube accounts went full-blown into the crash. And this is why we emphasize reading is a good thing, right? If you were able to read what the data was telling you, right, and then you're just like, whoa, housing is stabilizing. It's going to take a few months for it to hit the data lines, but by March and April, we'll see it. And shame on all of them, because it's not like we are advocating reading and trying to teach people how to read forward-looking housing data, and we have that access here, and it's worked for decades. But it's sexier to say home prices are falling 20-30%. I just went back and remember reading all the stuff in October, November, December, and how the big crash was going to come, and it's just, we are in a different environment after qualified mortgage came in. So I think we're trying to teach, and higher rates can create more active listings, but in the sense of you're going to have days on market grow, and then that could facilitate, because the products that are available or the homes that are available, it's not a lot, but if home sales are slowing down, it takes longer to sell those homes. That's the way people should look at it. And that's been here for 13 years. Think about the purity of data that we look at here, and we're educated. We could read, we could see, And the data has always taught us that. This is why the mortgage rate lockdown, when people are able to listen to that, you can see there's a historical reference here, because that's what the data has told us. This we're not trying to create a false narrative for attention. Once the data line changes, we can incorporate that variable into the model and say, well, this happened here, but it just hasn't been the case, especially the last 3 years, in the most violent period in time in recent history with housing data, because the credit channels are so different. Rates matter more than anything.
I would also point out that, with Altos research data, we don't have to wait 3 months to know if there's a big spike in inventory all of a sudden. We would know within a week, right? I mean, that's updated weekly for every MSA in the country. You have access to that data. I mean, I have access. I just don't know what to do with it. You get to look at that, and
it is amazing to me. I was talking to a real estate agent a few weeks ago, and I was thinking, how the National Association of Realtors not acquiring Altos Research and giving this product to all their real estate agents. If you want to provide value, to your real estate agents, your brokerage, I mean, this is not, we make this joke, this is not the 1400s anymore. We don't dispatch horses to go get a piece of parchment, and then 6 months later, that person comes back with their horse and go, oh, by the way, the Spanish Armada is coming to invade you. Okay. We have data up to every Friday. And because it's up to every Friday, and Altos Research gives you so much more, because they could tie it to your zip code. They could tell you how hot your market is, how cold your market is, seller, buyer market. There's all these things. And still to this day, we have institutions that aren't using the most modern day technology. Do you know what that makes them, Sarah?
I think it makes them old and slow.
Yes, and in this day and age with technology, you don't want to be that, because your being slow is so obvious, right? And that's why we track forward-looking data. But higher rates can do this. It's just, it takes time, and we haven't had a normal housing market post 2020. Nothing like we saw in the previous expansion. So that is, number one question: how do we get inventory to grow? How do we get inventory to grow? And you don't want to just use the same answer like a lot of people. Well, job loss, recession, kick people out. That's a very short-term thing, because majority of people are always working now, and not every homeowner is going to lose their job. So it's a smaller piece of the pie of the total units, but in this case, in this environment, because we're working from the lowest levels ever, you can get that kind of trickling up, slow inventory growth, and then that's the only way you could create balance, because the builders build single family homes. They're usually on contract, and as soon as they're ready, somebody moves in. It's not like an unoccupied house. And every event we go to, Sarah, we always ask the question: does anybody know how many new homes are available for sale today? Nobody answers it. I say 76,000, 75,000, 72,000. In a country of 335 million, 157 million, this is all that is available, right? Because the builders have this business model that doesn't flood inventory. Second of all, they don't even build homes that fast. It's like people think these are magical doors that are just going to snap their fingers, and go, hey, listen, here we are. Oh, there's a vacant lot. That's not counted as a shadow inventory. Tomorrow that home's going to come on the market and cut their... People, man, people, read.
That's why we have you, Logan. And I think it's true that, I live in an area where there's a ton of building going on, but I will tell you, they only do a few spec houses at a time, and then everything else is under contract. If it's not under contract, they're not building it. They're not going to just be like, let's just build a bunch of spec homes hoping people buy them. That is not their model, at least the ones around here.
Sarah, now you understand why I want everyone on a live debate, because unfortunately we live in a society where disinformation campaigns are very popular. You could lie whatever you want, but here in this case, trying to teach how inventory grows is I mean, we've done it, right? We've gone through these crazy periods of times and these major supply spikes that people have been talking about for 12 years now. This is year 12. Just hasn't happened. But I don't care about the answer. I care about why. And it's crazy. Just like this week, the bond market, mortgage rates, the Fed. Crazy, crazy, crazy.
Okay, let's talk about that. That's the next topic for discussion. We wanted to get to inventory, but obviously, I think you told me that because you track these things, we had another Fed president come out and talk about the fact, kind of try to talk down this market.
Okay, so many, I mean, God, it was months ago. We brought this concept of when will the Fed step in and start to try to intervene in the marketplace. And when the 10-year yield was at 4 to 4.25%, they started to talk about this is very restrictive. And because it's restrictive, this means that if the growth rate of inflation falls, they will cut rates next year. Right there, that's what they told us. So you go with that. So, I mean, one of the reasons why I had 4.25 at the peak is that if you look at the trend growth rate of inflation, real yields would actually be here. And right on cue, they got there. Of course, the bond market went against the Fed. So now we're sitting here and we're waiting to see, does that premise hold true? Do they actually come out? 9 Fed presidents have now come out now and are trying to say, hey, we're not hiking rates. We're not hiking rates. And when we wrote that article about the CPI inflation report, the internals are actually pretty good. Shelter inflation, at least the rent side of it, spiked up a little bit more than what people had thought, but that's still going to be in a downtrend. So that Fed report is, I mean, that CPI report is actually what the Fed wants to see. And again, the 10-year yield spiked. There was a terrible auction yesterday. We're talking, this is Friday morning. And then overnight, the 10-year yield fell again, another 10 basis points. This is very wild activity. This usually happens around a short-term top in the 10-year yield or a short-term bottom in the 10-year yield. You get these, violent swings around key technical levels. But now it is apparent to everyone that the Federal Reserve is now trying to talk the market down, trying to not to let the market get ahead of where they want it to go. So clearly, like I always talk about, real yields got real on them. And if they don't intervene, just intervene in terms of message, then they're basically saying, we were wrong a few weeks ago. We think we need to be even more restrictive because the economy is so hot and the labor market. And just remember, jobless claims, right? We always focus on jobless claims. Another good number. We're on the verge of breaking under 200,000 on the 4-week moving average on jobless claims. Now, continuing claims, people that file for unemployment benefits after 10 days, this data line is going to start to increase. It always increased on the seasonal side. So that's a very seasonal data line. So don't put all your eggs in that basket unless the 4-week moving average jobless claims breaks over 323,000. Then the labor market is broken. That's a whole different story. We're not there yet. So we have enough evidence now to know that this area the Fed isn't comfortable about, right? Even with a hypothetical, maybe some people thought the inflation data was hotter than normal, but the core inflation data is all they care about, and that trend is going low. So it's been a very crazy 12 days. It's been a very crazy year, but we have something to work off. And I always do this on Instagram where I take the 10-year yield and I show the charts and I say, hey, look at this. This kind of looks like what happened last year. We had the top, we had tried to test on the top, and we're starting to create a downtrend, and it's still kind of intact. So until that breaks out, the short and medium trend should be going lower. And now, unlike last year, where the Fed was very hawkish and no, we have to raise rates, recession, even if recession happens, we don't care. You all have to lose your jobs. Our life is difficult. Why are you doing this to us, Americans? Stop spending, stop buying stuff, leave us, it's a little bit different now. So it just means we have to focus more and more on the data internally. And this is why, we highlighted jobless claims data more than the growth rate of inflation this year. And the jobless claims data was good, and bond yields are not, they're above 4.25. So we have to explain why. Why is this happening? And we're at the inflection point to where the Fed is trying to talk the market down. Now, if they wanted to, they could change all this. They can say, okay, we really feel that this is too restrictive. We don't want a recession. So we're going to pause on our quantitative tightening until we get more evidence on inflation. They choose not to do that because that's a pivot. So they have the option to do that within a second, but as an institution, they're saying no. This is why this is not a Fed pivot. I know some people tell me, "Oh, the Fed's pivoting." No, they're not. If they do that, then bond yields have they can get bond traders to start buying in very easily. But for now, they're just trying to talk the market down.
So, you've talked about like, I hope this is a top that we're seeing, right? And things might go, might go lower. We're in October, middle of October. I feel like there are some people who've already written off the rest of this year. Of course, if you're running a business and you're trying to, survive until the new year, that's not true. I'm not saying people aren't working, but just like as far as all this, it's like, listen, it's just going to take to the end of the year to get, maybe mortgage rates in a better spot, maybe inventory. Is that your view?
Well, here's the thing. When mortgage rates came to 6% last year, and all of a sudden purchase application data was growing again, and we had one of the biggest month-to-month sales prints ever recorded in history. Now, I caution people, be careful of reading too much into that because we're working from such a low bar. But President Kashkari of the Minnesota Fed came out and said, no, this is not good. You're making our lives more difficult. Okay, so that was back then where the growth rate of inflation was still too high for them. So in this case, for the first time, you might have a Federal Reserve that will try to keep the markets from getting worse. Now, the problem is we're at 4.63% on the 10-year yield this morning, where we're at. The 10-year yield needed to get, kind of in a range between 3.37 to kind of 4% to get that activity. And because we're working from such a low bar, it doesn't really take much to change the narrative out here. And again, if the Fed wanted to, they could easily just say a few things, keep short-term rates high and let it go. They choose not to. But if that occurs, because we're working from such a low bar, we might have another repeat of last year to that degree where we get actually some purchase application data growth, but we're still too high yields. Now, the interesting thing is this week, purchase application data grew, 1% week to week, and the year-over-year data being down 19%. That's the lowest year-over-year decline in a long time. But again, the year-over-year comps are extremely easy, like the easiest comps we'll ever deal with, because last year at this time, home sales were crashing. Even though, on November 9th, our day in infamy, we wrote about this. We're like, man, home sales are crashed. The forward-looking data looks so bad that we're going to get to 4 million. Now, mind that we were near 5 million sales still while that was happening. That's how bad the data was getting back then. So we have very easy comps to show improvement, but it doesn't take much. But as of right now, the 10-year yield is simply too high. And this is why we're having every institution in housing calling in saying, hey, Fed, stop rate hikes. Somebody do something to help it. And I would be very curious if the Fed kept on saying housing's recovering. Nobody worry, housing's recovering. And it said it's hard to defend an institution when an institution says one thing, the data doesn't say it, and then all of a sudden the institutions that are in that sector are telling you, help, we need help. And it's a very interesting time at this point, similar to what we said last year. But last year home sales were crashing in the fastest fashion. Here we're just like hovering around 21st century lows.
So we have, you always talk about the X factor or other, external variables that are going to impact the bond market, which impacts mortgage rates outside of all the things we've talked about. And of course, we have that right now with the escalation of the conflict in the Middle East between Palestine and or between Gaza and Israel. And so, we see other people, trying to escalate that out even more. In your opinion, what does that do? How does that play into this?
As of right now, I would say the Fed matters more to the bond market than that. I would imagine that if none of the Fed presidents and Secretary Yellen, if they didn't come out and started to try to talk the bond market down, we would probably have higher yields than today. Usually what happens in a situation like this, the dollar gets really strong. People pour money into bonds and the dollar is the safe haven. but just to me, it looks more like the Federal Reserve statements matter more here, just because bond yields are so high now in relationship to where they were the last 2 to 3 years. But if escalation can mean supply disruption and war is always inflationary, okay, we're not there yet, but it's something to keep an eye on. Like all X variable factors, you want to keep an eye on, because remember, we have a situation in the Middle East, we have a situation in Ukraine, and we always have the China, Taiwan lurking in the shadows out there. That's 3 fronts, right? That's the BRICS, guys. Everybody says dollar's going to collapse. The BRICS are going to take over the world. Yeah, okay. Listen, they're not our friends, all right? So like sitting there and saying, go Russia, go China, go, come on. It's King Dollar for a reason. But one of the things that I'm seeing, at least from my view, is that the dollars was getting stronger, but it's not like what it was last year. The dollar got up to 114, all hell broke loose. So it looks like to me the market is thinking it'd still be contained. There's no escalation out here. But we'll see. It's a very delicate time on multiple fronts here on that side too. I think people have to realize we have 3 potential incidents that could all happen at once. 2 of them are live and well. The third one is the big one that isn't occurring. So whenever you have, a room full of gasoline, all it takes is kind of one match and the whole thing goes. But we're not there yet, but we have to be mindful of it. And that's this is our history, right? The history of the world. Conflicts happen all over the world. This one we have to be a little bit more mindful of if it escalates. Escalation is the joy drug of chaos, and that's what chaos wants, more chaos. And hopefully something comes about in the next few weeks to resolve this and keep it in its context. But as of right now, I still say what the Fed in the relationship to the bond market and mortgage rates mattered more in that. So we'll see how this progresses for the rest of the year. But I would be more mindful, especially if the 10-year yield gets closer to that 4.87%, guys. That's the key level right now, 4.87%. Go look at your 10-year yield charts. Take a look at that. Draw that line from the top of there and see what happens. Go back to 4.25% of last year. So you'll understand what I'm talking about. But yeah, we're mindful of everything, Sarah. This is just another thing added to the mix after 2020. Chaos. It's always here.
Lots of things. Logan, thank you for your part in helping us understand the chaos, and thank you for being my partner in crime, even if you did beat me according to the room that we were in on the mortgage rate lockdown.
Sarah, I give you an A for effort. Listen, Sarah, you get an A for effort. Do you know all these arrogant stock traders who talk a lot, and when I say let's go, they all just run away? You did not fear going against me at all, right?
I do not.
That's
fear
a good
going
thing.
Against you.
So
Nope.
and you put up a good effort, but I think one of your mistakes you made that in the next debate, if you're going to try to use my own words against me, remember that my model that I create is there for a reason. So I anticipated you doing that as the editor. That's what you would do. You'd go back, and then the counterpoint was just waiting for that. So the key to my debating tactics is I have to let the person do the work for me. And I thank you for that. And everyone will get to listen to that.
Well,
and
I will take note.
I just want to let you know that victory pretzel that I had tasted very good. So thank you for that.
Okay. Thank you again, Logan. And we will talk to you again soon.